The long-awaited report from the President's Working Group on Financial Markets urging lawmakers to subject stablecoin issuers to the same federal oversight as banks. The report further urging that custodial wallet providers be regulated by a federal agency and non-financial companies such as tech or telecom providers should be blocked from handling stablecoins. Joining us now with the report is CoinDesk Global Policy and Regulation Managing Editor Nick Day. Hello there, Nick. Good to see you. So this has been a hotly anticipated report, and in it outlines three key risks. Maybe you can begin by telling us a bit about that.
Hey, yeah. So basically, the President's Working Group, which is composed of the top financial regulators in the U.S., evaluated stablecoins. They found that they have identified risks regarding, investors and investor protections, risks around the actual, tokens themselves and their issuance and governance, and potential risks to the broader financial atmosphere. So they found that stablecoins could one day pose a risk to what they termed the real economy, the non-crypto economy.
So maybe you can go over some of the recommendations to address those risks. They have regulation on custodial wallet providers as well as stablecoin issuers. Can you break it down for us?
Yeah, so the key thing here is the group wants Congress to act. They want Congress to draft and enact legislation that would subject stablecoin issuers to basically bank-like regulations, as you said at the beginning of the show. They want stablecoin issuers to be federally insured depository institutions. So they would report to the Federal Deposit Insurance Corporation and possibly other federal banking regulators like the Office of the Comptroller of the Currency. Both of these agencies were part of the drafting of this report. And in doing so, what the legislation could do is basically force stablecoin issuers to be a bit more transparent about what's backing their reserves, ensure that these reserves are backed by for lack of a better term, let's call them approved, items. So one of the risks they pointed out was the fact that some stablecoins are backed by commercial paper rather than, fiat assets in a bank account. They hope to secure the custodial wallet providers that actually provide services for stablecoins and ensure that, there's no risk of, funds being lost or issues around, the fund transaction and settlement during transfers. So it's a pretty broad set of recommendations, but it's all kind of centered around what Congress can or might do and whether or not Congress will enact this legislation to basically regulate stablecoins in the US.
That's interesting because stablecoins many of them are global, just like Tether, USDT, or USDC. So how do they expect to be able to regulate a global industry that issues stablecoins?
That is actually, I think, one of the outstanding questions. So the report itself says that the legislation wouldn't apply to stablecoin issuers that are, domiciled in the US or that are accessible by U.S. persons, or that have in literally a quote, a U.S. nexus. So Circle is based in the U.S., so it would be subject. Paxos for another example. But to your point of Tether, it's a question as to how exactly this could be enforced. A Treasury official did say that it's possible in the future, not immediately, but well into the future, they might look at maybe crypto trading platforms, for example, and enforcing regulations around how these platforms handle stablecoins. But at the moment, at least, they're just kind of focused on stablecoins that do have a recognizable headquarters or easily recognizable access points within the U.S.
Yeah, it's interesting because something like Tether, it trades in Asia, and they may have a certain outlook or perspective on how to regulate stablecoins there versus the United States. So how do you make all of that align and interoperate with U.S. laws? They also took aim seemingly at Diem, formerly Libra, the controversial stablecoin project created by Meta, formerly Facebook. Perhaps you could tell us a bit about their focus on not having tech companies get a hold of stablecoins.
So this kind of goes into the whole financial stability concerns, but one of the issues that the report identified, or at least explained in their view, is the risk that you'll have a stablecoin issuer that has access to, for example, credit information and other private financial data of an end consumer, and therefore be able to possibly restrict what that consumer can buy using their stablecoin holdings, or otherwise monitor and try to control their financial activity. And this is a concern that was expressed around DM back when it was first introduced, as Libra in 2019, and it's even a concern we've seen kind of growing with the Facebook Marketplace. It's not a new concern, but it is one that they seem to think could be more and more applicable as stablecoins become a greater tool for payments. And part of that, throughout the report, were mentions of seeking to restrict stablecoin issuers from certain types of commercial engagements, basically trying to keep them separated from having this kind of ability or this kind of power.
Mm-hmm. I wonder if there is any risk you may foresee to Bitcoin and the crypto market with this report. If they were to go after Tether, which is the largest stablecoin by market cap, I believe about 69 billion in circulation out there, could this have an impact on Bitcoin and the crypto market?
So honestly, I don't really know what the market's implications might be, but there's certainly a concern where if they say a stablecoin has to have XYZ insurance and that stablecoin is unable to secure it, then they might try to restrict that stablecoin from trading and being used. And while that would be an issue primarily in the U.S., it might lead to arbitrage opportunities for people who are trading in an overseas exchange and then trying to come back to the U.S. or vice versa. You also have broader concerns. The report did say that it's going to look at, the administration is continuing to look at the digital asset sector at large. So, this isn't kind of like a one and done. This is the first report. I expect we'll see more to come in the years ahead. So it's possible that some of the lessons and conclusions that have been reached in this report might be revisited in a broader conversation about cryptocurrencies at large.
Now, just one last question. The President's Working Group is urging Congress to take action. What if Congress doesn't take action? Would the Biden administration take the lead here?
So the report was very careful to emphasize at numerous different places that the group really wants Congress to get on this. They want Congress to enact these laws. And if they don't, then they suggested that federal regulators like the Securities and Exchange Commission, the Commodity Futures Trading Commission, the Financial Crimes Enforcement Network, might all have different jurisdictions that they could use to start implementing certain regulations around stablecoins. And should Congress continue to not act or not pass a bill, the report further suggested that the Financial Stability Oversight Council, which is another interagency high-level policy group, could designate stablecoins as systemically important for payment, clearing, and settlements. And that would give a lot of these federal agencies pretty broad powers to try and rein in what they see as, a very rapidly expanding, unregulated sector of the crypto market. So basically what the report's saying is either Congress acts and, does this in a democratic, election process kind of way, or they'll let FSOC do it. And then you have the agency heads that are appointed and confirmed by Congress, but not elected, taking action on their own.